Hi, Steve Van Metre here, and welcome to your weekly economic update, where stock markets rise hopelessly on trade-related news. Meanwhile, the economic data says the global economy is in dangerous shape. But we take about 30 minutes every Friday to try to see if any of this stuff makes sense. And it does, to the extent that the stock market has it completely upside down. So I want to talk about trade war, and I really don't want to talk about the trade war, but today we got some insight into what's really going on. And it's much simpler because yesterday, after markets closed, with the S&P 500 needing to get to 3,100 today, because there's about 16 billion worth of options that were coming due. These are speculative positions. If you've ever watched hockey, there's something called dump and chase. And speculators do this in the market. We've talked about it before, but I'll give you an example of what it means. So every quarter, thereabouts, or in between, people will buy options. And options is the opportunity to buy at a future point or sell, depending on which direction. And so people took speculative positions at the S&P hitting 3,100. In fact, it was the largest speculative position at the 3,100 level. Not just that level, but the largest dollar amount in history. So the market needed to get to 3,100. Now in hockey, the way this works is when the defending team gets the puck back and they're about to move it across the ice, sometimes you'll see one of the defenders, sometimes an offender, take and hit the puck so it goes as far back onto the other side of the rink as possible. Preferably into one of the two end corners, or even if they can get it to wrap around behind the net. This is called dump and chase. Now they do this sometimes to do what's called a line change, where they're swapping players out. But what will happen then is the three offensive linemen will start chasing the puck. And by the time the defensive players have swapped out, hopefully the offensive players have corralled the puck and kept the defense busy so their defenders can get into place, called dump and chase. Well, that happens in the market too. So you had these speculative positions taken out. And then when the economic data started suggesting that, no, the market shouldn't be at 3,100, it should be nowhere near that, then the speculators have to do is dig into their pockets and start putting a relentless bid under any time the stock market dips. And they do that because they want to collect on their speculative bids, and they feel they have a chance to. And they'll do other things. For example, they will sell treasury bonds or short treasury bonds. So if they don't own them, they will short them. And when you short something, you borrow it from a securities dealer, then you go out on the open market and sell it, and you get the proceeds from the sale of it. Now we'll assume there's transaction cost fees to the dealer, but materially aside, they get the money from selling the bond, and they take that money and they buy stocks. So they'll do anything they can to get to that level to get to their payday. Now, oftentimes after these levels get reached, you'll see a reversal. So maybe in the next week, we'll see a reversal. But what's really odd is over the last several weeks, the data could not be further from the truth of where the market is. The data looked pretty ugly. Anyways, back to the trade war. So there's dump and chase in hockey terms for, I guess they do this in soccer. I don't know. I don't watch soccer, but maybe they do dump and chase in soccer. All right, so Larry Kudlow came out yesterday when markets were, after markets closed, when liquidity was thin, and said that we're close to a trade deal, which kicked the computer algorithms up to this 3,100 level, which made, of course, a lot of speculators sleep really well last night because they knew they were going to be able to collect on their options when they went into expiration. So that made them happy. But Kudlow then today came out and said, well, we're close to a deal, but President Trump's not going to sign it. So here's what's really, now that I understand what he's saying, this is what's really happening. The negotiating team on both sides is trying, you've heard something like, they're trying to get something on paper. Okay, they're trying to get a deal written on paper. Now the Chinese side, they know exactly what they want. They want a low value, dollar value in terms of agricultural commodity purchases, and they want all the tariffs rolled back, and they don't want to agree to anything else. And if you don't think that's coming from the big guy, President Xi, you're wrong. It is. They're doing exactly what he says because that's how things work in China. Now, the negotiating team on the U.S. side, on the other hand, is trying to do whatever they think is best, meaning they don't care fully what President Trump wants. They're just trying to say, look, we got a deal. Please sign it. So this deal on paper is going to probably have some form of rollbacks in it because that's what China wants. China's been clear. We're not going to, no deal, no rollbacks, no deal. So the negotiating team on our side knows that, so they're going to try to put it on paper to say, okay, look, if we go along with this, if we can get President Trump to sign off, there will be a rollback. But President Trump, from sources inside the White House, said today that he is not going to sign anything that has to do with rollbacks. He does not want that. So on one hand, we're close to writing something down that President Trump's not going to sign. Now, I don't blame him. It's his trade war. He doesn't have to sign it. He's not going to, because the issue then immediately in this article said, without the tariffs, there's no enforcement. Bingo. And that is the whole root of the deal. There will be no rollbacks. So we're going to continue to be close to a deal. We may even get a written deal down, but it won't be worth anything until it gets signed. The content of this video provides educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by any security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that I'm on and do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. All right, let's go look at some economic data, because the economic data, I'm not going to go the last 2 weeks, just could not be more disinflationary, or which means slower inflation, or deflationary, which is the outright contraction. I mean, you would expect on a day like today, the stock market should be down and the bond market should be up. The bond market was down slightly, the stock market was up. You wouldn't expect that. All right, so here's South Korean exports year over year, meaning this time in October last year, their exports fell 14.8%. Now, these are not all going to the United States, but South Korea is a major exporting nation. So if they're exporting 15% less than they did last year, what does it mean? They have 15% fewer orders, i.e. less demand. Now look at imports, which is essentially confirming the export data, saying minus 14.6%. So this is confirming we have a demand problem. We don't have a tariff problem. We have a demand problem because American consumers are paying the tariffs. But these South Korean exports are not just going to the U.S., they're going all over the world. And what they're saying from the global economy is we're getting 15% less orders, so we're exporting less. But because we're seeing less orders, we're importing less stuff to make stuff. This is confirming the South Korean economy is slowing. And this isn't new. If you look at the export data, you can actually look pretty much over the last, say, year, it's been getting worse. And the last time you saw that was when we almost had a recession in 2016. And you can look even here, 2000.com bubble was in contraction. And in the mortgage bubble's contraction, here's 2015, 2016. Here we are now. And all these data points eventually get to the U.S. because if we're importing less, and we'll just say that of our slice of this piece, it is 15% less, then that means U.S. retailers, U.S. wholesalers are all not selling stuff. They're selling a lot less, and that turns into fewer corporate profits. Now let's go into today's data. As you can see, we are at investing.com under the economic calendar. Let's look at more deflationary or disinflationary data. So the South Korean data is deflationary because it's contracting. How about export prices? Remember, we've heard it, and I've told you the trade war is not inflationary. The market says it is. Export prices out of the U.S. down 2.2% from a year ago. Import prices into the U.S. down 3% from a year ago. That is deflationary. So tariffs are having no effect. In fact, they're having the opposite effect that the market thinks. Let's look at retail sales. Year over year slowed from 4.07 last month to 3.1%. That's disinflationary. That's saying consumer demand for retail sales is slowing. What else we have? Capacity utilization. This is what percentage of our factories are being utilized for production. When this number goes down, so it went from 77.5 to 76.7, it tells you demand is falling and factories are producing less, and interest rates generally go down as capacity utilization falls. You can see industrial production down, here it is, year over year, 1.13, even though it was only slightly contracted last month at negative 0.7%, it's still contracting. How about manufacturing production down 0.6%? So here, industrial production, this is deflationary. Manufacturing production, disinflationary. This is not good stuff. So again, as I've kind of said, when you get those kind of data points, you would expect interest rates to go down because it's telling you demand is the problem. The supply chains are full. Retailers have plenty of inventory. Wholesalers have plenty of inventory. The shipping ports have plenty of inventory. They're all full. We have a demand problem. It's not due to tariffs. Think about this. When's the last time you went to the store, picked something up off the shelf and said, oh man, due to the tariffs, not going to buy it? Did it have oh, look at this, there's a tariff markup? You know how the shipping companies do that gas surcharge? I hate that. Do you see a tariff surcharge? No. Why? Because corporations are eating it for the most part. Yeah, I know prices are going up some, but not to the extent, of some of these 25% tariffs. You're not seeing that pass through. This is a demand issue of what's going on. All right, into the PowerPoint slides we go. I wanted you to see the data because I put that on my website, Facebook, and LinkedIn every day. Maybe you don't know what it means. Maybe you don't understand, but I wanted to kind of walk you through that to see it's not good. It's not good at all. In fact, you know what? Before we do this, now that I'm thinking about it, let's go over to here. Let's look at retail sales. Remember, we looked at this on Wednesday. Right, because we didn't have video on Monday. Manufacturers' new orders falling, and what happened to retail sales? Went from 4% down to 3%. And what happens when new orders fall? Why would they fall? If you're a retailer and you're ordering less stuff, why is that? Because people are buying less stuff. And what does that eventually mean? That retail sales are going to head lower. Here's something that validates lower retail sales. This is a cash freight shipment that looks at North American shipping. It's in blue. It's been in contraction for 11 straight months. So it means less stuff is being shipped in terms of dollar amount and volume. Well, no surprise, the retail sales goes down. People buy fewer things. So what's happening here is you see new orders and cash freight shipments are essentially validating that the U.S. economy is slowing. It is a demand issue. Looking at industrial production on a year-over-year basis, well, it's not really contracted much. There's only a handful of times where we've seen a contraction in industrial production that didn't lead to recession. Now, mind you, the markets think we're right here in this mid-cycle adjustment, according to Fed Chair Powell, where industrial production didn't actually contract in 1995, and we had a resurgence. This is what the market's betting on. But you can see most of the time, with the exception of 2015, 2016, which China and a surge of pent-up demand due to lower interest rates helped the U.S. economy turn around, there are hardly any times this thing turns negative and there's not a recession. Here's one right here. There's a one right there. Now you see it rebounded real quickly and a slight change there. But you can look at if we zoom in on the 10-year, you can see this thing is in downward trend. There's no indication of it slowing down. So 2 months of contraction, and it's probably going to get worse because we're seeing new orders fall, cash freight shipments fall, and you're also seeing stuff out of Korea fall. So it's telling you this thing is getting worse, not better. So let's take a look at the M2 money supply. Now the growth rate was up slightly at 7.22. Now this is really hot. I mean, this is way higher than I would have ever expected to see it. I mean, it's back where it was following 2016, not far from the post-quantitative easing world of QE2. The 6-month rate of change is telling us this thing is going to go to 9%, which is, very, very high. The 3-month rate of change is validating that it's going to 9%. Now, the question that is worth asking here is what's going on? So how do you read the money supply? money supply is future demand, effectively, right? So think about it this way. If American consumers are filling up their bank accounts with money, because maybe they have too much, right? We're not seeing demand, so maybe they're stacking up that money. What does that mean they're going to do? They're going to go out and buy stuff, right? And even better, they're going to buy stuff that they can't afford because they have money in the bank. That means, you have to think, it's like, okay, well, if an American consumer had 50 grand saved up, right? And they're going to go buy a home, are they going to say, okay, well, I have the equity in my home plus 50 grand, I can buy this other house? No. They're going to say, the equity I have plus 50 grand means I can buy a huge home with the same payment I have now. You got to think like a debtor. So if you're not a debtor, you got to think like a debtor. I could pay cash for the reasonable car, or I could go buy that $120,000 BMW I always wanted to put a big down payment and get my payments lower. That's how the American economy works. So if you see consumers building up cash, it either means we're having a recession and they're worried about it, or two, they got so much money that they're just stashing up, getting ready for whatever's going to tell them that it's now safe to go spend. So the question is, where is this money? Well, I'm going to show you. Whoops, not that slide. Let's go over here. So here's the underlying data from the M2. And we can look at savings deposits, and we can say, okay, from a year ago, yeah, this is pretty good. From preceding period, not a lot of growth there, but okay, there's growth in savings deposits. How about small denomination time deposits? This would be more like CDs. Yeah, okay, there's some growth there from a year ago, but from, the last period, there's not much growth. Okay, well, what else do we have? Currency, currency is going to grow. That's not surprising. Demand deposits is like checking savings accounts. Okay, there's growth there. That's pretty good. Oh, wow, look at this. Institutional money funds. There's your big growth. What is institutional money funds? This is money market accounts. And where do you typically see money market accounts? In brokerage accounts. Now, why would this be growing? And here you can see. Let's analyze this a little bit. In fact, let's zoom in a bit. This is quantitative easing, right? All through here, QE1, 2, 3. And notice how QE2 and QE3 took a drain on money market accounts. Why? Because people took money out and invested it. Now, the Fed is doing quantitative easing. They're not going to admit it, but they're doing it at $60 billion a month. So if quantitative easing was going to spur demand, why are people building up money markets? And who are they? Well, there's an article that has been floating around now, I think, for a few days that says effectively ultra wealthy people are selling stocks. Well, no surprise, they've been selling stocks, but they own half the market. So they got a lot of stocks, okay? They could sell and still you wouldn't even put a dent in it. Where's that money going? It's going right here. It's going into money markets. And look at the percentage change from a year ago. This money is growing at 20% on an annualized basis. And you can see it normally grows around a negative percentage. So it doesn't really grow that often, except going into recessions. So what's happening? And yeah, you see it building up here, but you see it gets really speeding up toward the end of the cycle. So why are these people putting money in money markets? Because they know the global economy is going down. They do. Okay, back to the PowerPoints. So this is not inflation. Now you can say, oh, well, that means all this money is going to come back in to buy stocks and push the stock market higher. You're right. When stock prices are lower, it's going to. Could go into bonds. You could see, it wouldn't surprise me if we start seeing money flow into bonds from it. All right, the big daddy, real estate loan growth, flat at 3.56% from a year ago. 6-month rate of change decreased to 1.53. The 3-month rate of change took a pretty big tumble. It was over 1% last week, I believe. And as I said, higher interest rates, which aren't that very high, lead to lower demand. There you go. This is not reflation. This is disinflationary. Commercial industrial lending down to 4, not much, but down to 4.44 is at 4.48. But look, 6-month rate of change, it fell almost back to zero. The 3-month rate of change continued to slide and slightly deeper into negative territory. Now, this might pop out of this in the next couple of weeks, and I'll show you why, but it'll be temporary if it does. And then now, remember I told you if we put the two together, and I've been talking about it, but here's the chart of the two together, commercial industrial plus real estate, loan growth combined. Growth rate is down to 3.86 from a year ago. 6-month rate of change is at 1.02. Double that is telling us that this whole thing is going down to 2. 3-month rate of change is at 0.34, or about 1.3%, 1.4% a year. So it's telling you the money generators are not generating money. That is disinflationary. Now we can also go and look at the assets and liabilities of commercial banks, and we can zoom in a little bit and see what's going on here. We can see they added overall securities. They did add about $7 billion bonds, mostly in mortgage-backed security. So if we look here, you can see they added $8 billion in mortgage-backed securities, shed about $7 billion of Treasury bonds. This is right around the time the Fed was going to, the Fed announced the rate cut. So that does drain money out. So it's possible these are mostly T-bills. We don't know the breakdown. Looking at other securities that are fairly flat on mortgage, non-insured mortgages, and added a couple billion of non-government bonds. But look at loans and leases. This is all the loans in the banks. 9.949 trillion, down from the prior week. You can see commercial industrial lending popped up about $4 billion. There was a very large loan, and I don't know if it's showing in here or not, that apparently was going to come online, and that was going to boost this up. But this is not huge growth. But you can see the real estate loans, 4.559, down from October 30th, down right back where it was on weekend in October 23rd. But look, generally this rises. So what you can see, there's no reflation going on in the real estate market at all, period, none, zilch. So anyone that's saying, oh, there's a lot of reflation going on, there's not. Again, you think interest rates, is this not validating, my view that I said interest rates need to go lower? This is it. You're seeing it. Need to go lower. All right, let's move on. Consumer loans, credit card growth rate flat at 4.6% from last year. I didn't even update the chart because, well, it's flat. Looking at now, this is cool. This is really, really cool. This is China. Not that I care much about China passenger vehicle sales on a year-over-year basis. Now, I don't have the data, so I'm using this chart, and I can't overlay it against the chart I want you to look at. But just kind of in your mind, kind of get a picture of what this chart looks like. So you see, just kind of the general flow of it, okay? Now remember, the trade war is supposed to be killing China's economy. It's not. It's the Fed's tightening. Now, how do we know that? Because here is world dollar liquidity, the sum of federal debt held by foreign and international investors plus the monetary base. And I try to line these up about the same period. Notice the similarity? Here, look again. See, 2006 to 2019. Somewhere in 2006, 2019. It's a contraction of world dollar liquidity that's causing the global slowdown. It's not the tariffs. Tariffs aren't making it better. They didn't cause it. Fixed net speculative positioning, all-time low, meaning speculators are now more short volatility than they've ever been in history, and probably as of this week, even shorter. Some people say this doesn't matter because there's an opposite end to this trade. It does matter because it's speculators. And speculators, when things go the other way, they quickly move out, and that causes a short squeeze. So yes, this does matter because who's on the other end of this? The smart money. And last chart I want to look at is the Fed Senior Loan Officer Survey, which leads, this is inverted. This is a great chart. I try to copy down the data, but it's not in a downloadable format. So it says U.S. banks tightening commercial industrial loans, 1 year change, so year-over-year change, advanced by 2 quarters, inverted. And what it's showing is capital goods orders, essentially durable goods orders, and what you're looking at, something like that's effectively what you're looking at, except larger. Is saying that when the Senior loan officer survey tightens, in this case inverted and falling. It says capital good orders are going down with it. So again, the banks are tightening financial conditions, which are going to cause a recession. All right, on to the NASDAQ McClellan Summation Index. Liquidity hasn't, let's see if we refresh it here. Not up a whole lot compared to the market, so it's still telling us liquidity conditions are tight. Something that nobody is talking about right now is the situation in Hong Kong. I mean, people are talking about it, but what the Hong Kong economy is now officially in a recession, and it's not getting any better, and capital flows are headed out. Money is leaving the country. Could this lead to bank failures, bank runs, and what is the domino effect of the global economy? I don't know, but certainly isn't pretty. All right, now I've got only 5 minutes to talk about what I really wanted to talk about, and that is the Treasury debt cycle. Now, if you read about it in tonight's update, and so those of you who watch this video don't know what I'm talking about, it's on my website or stevenvanmetre.com, Facebook, or on LinkedIn. So the Treasury debt cycle has 4 phases. It's kind of like a 4-stroke engine. There is the the intake phase, right, where they're pulling in air and fuel into the piston, or in this case, the Treasury is pulling in money from the broad economy. Then there's the compression phase, right, where the gas and the air get crunched up. This is when the Treasury puts money into the savings accounts at the Federal Reserve and leaves it there. Then there is the combustion phase, or the power phase, where the spark hits and all that pressure lights the gas on fire and pushes it out. And that's how the money comes back out of the Treasury into the economy. And there's effectively the exhaust phase, where it's blowing out and into the economy and everything looks good, and then it restarts. Now, this has a big impact on the economy, because when the money is pulled out, for whatever reason, it gets removed from the monetary aggregates. And I don't know why, because we see the money, we know where it went, the Fed accounts for it, but when it comes back in, it looks literally like just sticking adrenaline needle, a shot in your arm and go squeeze. It literally feels like a direct injection of money into the economy, but it also, when it's pulled out, it feels like a direct drain. And it tells us a lot about what's going to happen with interest rates. And I want to show you this chart. This is the long-term history. And you'll notice the Treasury deposits with the Federal Reserve were never a big issue until the financial crisis. So let's zoom in to where it matters. I just wanted you to see that I wasn't hiding anything from you. And all of a sudden, for some reason, the Treasury starts building up a savings account in between we don't have a budget, but the passage of the spending bills, to buy some time for Congress to do nothing until you have to either shut down the government or agree to pass a spending bill. Now, for some odd reason that I offer no explanation for, and we'll zoom in a little bit more so those of you on smaller screens can see it. Starting in 2015, these numbers got kicked up a lot. Now, it could be the Treasury realized they needed more money in savings, could be relative to the growth rate of the debt. I don't know. But they brought it up to $320 billion and eventually $400 billion. And now they're going to keep it at around 410 now, as of the cycle. So we see this draw up here, which is probably now completed. It should be up at 410 the next time this updates. And I have the PDF that shows when they're doing what, and I meant to put it on here, but I forgot. Anyways, it doesn't matter for the moment. So anyway, you see that they drew this out of the economy. So this is pulling money out. This is the intake phase right here and here. They're pulling money out of the economy. This is a compression phase where these tops are, which we're about to start having one. Now, normally when you pull money out of the economy, it tends to lead to lower interest rates. The market doesn't always interpret it that way because they see less money, and the market always assumes that interest rates need to go higher. This is the market's general direction, even though historically they go down in a debt-based economy. But look what happens during the compression phase. This money is just sitting here doing nothing, just waiting to come out. And why do interest rates go down? Because this money's gotten pulled out of the economy, and the economy wasn't generating enough money in 2016 due to what? the global economy was slowing down. Remember, we looked at the data, the South Korean export data, the industrial production, it was all contracting. So the economy, notice it's no different than it is now. None at all. None. Because this money is essentially yanked out of the money supply, sitting up here doing nothing, and interest rates go down because when there's less money in the system, interest rates fall, and they got down here at the low. It created some pent-up demand, and then what happened when the election happened, the money started to get spent out because remember there was no budget. What did Obama do? He said, "Look, I'm going to leave the passing the spending bill to the next president. I'm not going to mess with it. It's not my deal." I don't blame him. And then look what happened. Interest rates rose because money is getting flushed out of the savings account. And when money gets flushed out, remember we've talked about this in the past, it's like a sponge. Interest rates need to rise to sponge up that money. That's how interest rates regulate the monetary system. It's very important to understand that interest rates in a fiat currency with rules about central bank printing money, they regulate how much money is flowing around. So when there's too much money, interest rates rise. This is what you expect, okay? Now, let's go to the next cycle. We're doing nothing, and then finally there's an intake cycle, but because there's still so much enthusiasm, and because, what do we see? Lending growth is growing all through here, that the Treasury gets away with pulling money out of the economy, and it doesn't really hurt it, at least initially. But what happens up here in this top part, and when you get to the compression phase, I'm going to not put my mouse over it so you can see it. Oop, that's why. You notice how interest rates start to peak out because finally the drain of the money catches up with the economy, which is now overcooked. The lending growth starts to roll over and there's nothing left. But we extended this too long because of the tax cuts. You normally don't do tax cuts during a period of growth. You do it in a period where there's no growth to stimulate growth. So this got extended a little longer. So as money was flowing out of the Treasury, it was already too late. The economy was already slowing down and there wasn't enough money in it and interest rates fell. This is not normal, but again, this phase was extended again due to the tax cuts. Now money's being pulled out of the economy, which should be done. The market, for some reason, is interpreting this as inflationary, although it's not. And we know a lot of this movement here is due to the trade war. But look what happens every time you're in the compression phase. Either interest rates are flat because there was growth. Remember, there's lending growth up here. Or when there's no lending growth, it falls. Now, once this thing gets up here, it's going to go sideways because starting I believe this month or next month, the Treasury's got to borrow more money to fund the government through the first part of next year. So they're going to pull even more money, just like they did right here. So what happens to interest rates when the Treasury is borrowing a massive amount of money to fund the government, put money in savings, and the economy is weak? Interest rates fall. Hence why I mentioned in the update today, for those of you who are on the email list that are mostly clients, it says over the next 3 to 6 months, this Treasury debt cycle is very favorable for lower interest rates because the economy is slowing. And what have I told you is in a debt-based economy, interest rates need to rise or fall to spur demand. They need to fall. So what you're seeing is the Treasury is effectively kicking into the business cycle and modifying it. And now the problem is the Treasury is yanking a lot of money out, and I said this was going to happen at a point of weakness. And this is not good in terms of extending the cycle further. Now you say, well, I thought the Fed was monetizing some of this. Yeah, they are. But the Fed's not putting the money back into the broad economy. Well, I thought it was going to the banks. It is. It's going to something called excess reserves. And the Fed pays the banks interest on excess reserves not to lend it. So it really doesn't do anything. It's not really going anywhere. So why is the stock market going crazy? Because the stock market thinks this is like QE2 or QE1 or 0.5 to 1, QE2 and QE3. It's not. It's not working. So all this liquidity injection is no effect. And the Treasury is borrowing so much money. We're talking, I want to say over $600 billion between here. This isn't the actual low. It was actually down here. But they're borrowing, somewhere, I want to say somewhere around 600 billion out over a 6-month period. And the economy is not going to be able to handle that. And so what we should see is interest rates go down. And what we're really hoping for is a big drop in interest rates that yanks the market down. That's what we're hoping for. And the Treasury, what did we get an update on? No. The Treasury is helping us. And that's pretty cool, right? So when you understand the cycle, that you have your normal business cycle, but now all of a sudden we have the Treasury debt cycle that is interfering with it. So the Treasury also came to the rescue in 2016 because we had low interest rates and that flushing of money out. And now the Treasury is on the wrong side of the fence. They're borrowing a whole bunch of money in an illiquid time when the global manufacturing sector is in contraction. Where do you think interest rates are going when you look at all the lending data, when you look at the economic data? They're going higher like the market thinks? They're going lower. It's got to go lower. Got to spur demand. So I'm Steve Van Metre. We'll be back Monday. Take a look at what's going on with the speculative positions of hedge funds. And no doubt they have increased their short positions for sure. But we'll take a look at that and see what else is going on in the market. There won't be a lot of economic data until later in the week. And all that should confirm is further slowing in the U.S. economy. I'm Steve Van Metre. Hope you have a great weekend. Bye now.